thank you, Quants League, for having me over in this session. There have been quite a few brilliant speakers, as I've heard over the past few days, and today is day 5. And I'm sure all of you participants are having a knowledge-filled time, right? So I just want to first of all just get an indication of whether my audio and video is looking all good. So just a request to the host, if you guys can.
Yes, your audio is fine. The video is also all right.
Okay, great. All right, so I'm just going to go ahead and start my presentation. Let me share my screen. Okay. Is my screen visible with the presentation?
Yes, absolutely.
Okay, great. So thank you everybody for having me. I am Prashant Malik and I am a co-founder at QC Alpha. Our firm specializes in building trading models around the volatility of the marketplace. We primarily focus on trading the indices, Nifty, Bank Nifty, and to some extent currency USD INR. On the investment side, we also have several investment portfolios that we run. We do this through small case. They are focused on, again, quantitative aspects of the market, momentum, and the low volatility factors. So that's what we do at QC Alpha. Today, I'm going to talk about one type of trade setup that some of you might be familiar with, but I haven't heard too many people in the retail space talk about it. Primarily because it's a relatively higher capital intensive strategy, and it requires quite a bit of execution that you might need. But given how the execution space in our markets has advanced over the last, I would say maybe a year or two, it is just amazing to see so many brokers now come up with auto execution, seamless, automated transactional capability. So this is something that I believe a lot more folks in the retail space are going to be interested in exploring. So what I'll do is I'll go through some basic points around volatility that are important to understand, and then I will talk about this trading setup called the risk reversal. I will be pulling a lot from one study that has been done by Hull and Sinclair. These guys are, they have several books. One of them is like the God book of options, and then Sinclair has several books on practitioners' methods of trading options and trading volatility as well. So they came out with a paper a couple of years ago on trading the risk reversal premium for the SPY, which is the Spiders ETF in the US based on the S&P 500. What we'll do is we'll look at the setup from there. We'll look at what kind of results that they find, and then also we'll look at some very preliminary results on the Nifty. So we've taken that setup and then run some back tests on Nifty, and we'll show that, and see whether it works or not, and then leave you with some ideas on how you might be able to go ahead and back test further and go deeper into this kind of trading setup. Okay, so the first thing that we want to care about is, one second, my screen's not responding. All right, here we go. So before we get into what the risk reversal is, I just want to touch base upon realized volatility. I'm not sure if I'm able to see the folks in the chat, but yeah, I do have a chat window open. Okay. So if you guys are just with a show of hands, just type something on the screen. Yes. If you guys are familiar and think about volatility when in your trades, just show of hands. I know there's Santosh Pasi, there's Rakesh Bhai out here who are really into trading volatility. All right. So there are, all right. I see a few people engaged. Good. So at least some of you guys are still engaged while I'm starting. So that's good. So realize volatility, right? When we are trading the markets, we are looking for volatility. We are looking to understand volatility. We are looking to take advantage of volatility, because that is when you'll be able to buy low and sell high, right? If the markets are going to be just going up in a straight line, then what are you going to trade? You're just going to buy and hold and make money, right? But markets don't behave that way. They are volatile. And one way to understand how volatile markets are is to look at standard deviation of daily returns, right? So what you do is you take daily returns of whatever instrument you're trading. For example, if you're trading the Nifty, you'll calculate what your daily returns are one day to the next. Returns as in normalized to the previous price. So today's close minus yesterday's close divided by yesterday's close, right? So that's a daily return. You find the standard deviation of those daily returns and then annualize that by multiplying by square root of 232. Once you go through that math, you'll get a number, analyze historical volatility. If you're too lazy to do it, a charting tool like TradingView will spit that number out to you. That image on the right, it's got the Nifty chart. Traders who are looking at that will probably, if you wake them up at 2 a.m. in the night and show them that chart, it's a Nifty chart, right? And then what you have in the lower panel out there is the HV on a 20-day period. So what you'll see is that you have a long-term average of this HV somewhere around 17, 18, 16 to 18. And then there will be bouts of high volatility, 2019, 2018, 2019, and then of course COVID, which we all lived through. What you'll see is that right about now, the markets have become more volatile. You'll see this: the markets are not behaving like a lot of people who started trading last year have seen the markets only go up in a straight line. Markets are behaving more in a usual fashion that they used to behave, right? And you'll see that the volatility is ticking up. So this is realized volatility. This is what is actually happening in the markets. Market is going up, down, sideways on a daily basis. The other volatility that we care about is implied volatility. Okay, implied volatility, very easy thing that a lot of people follow is India VIX. India VIX is a measure of the implied volatility in the market. It is obtained from the options pricing on the Nifty contracts. It has a constant 30-day maturity that is used for calculating that options pricing. And on the chart on the right, I've shown you the chart for the India VIX, the values of India VIX on a daily basis. And what you'll see again is similar to the realized volatility that we had. You have the implied volatility, averaging or long-term average around the 17 number. Sometimes it dips down almost below 10, like we saw in 2017. Those of you who were trading in 2017 very well remember that. But then again, this is COVID. During COVID times, you have this big spike up in implied volatility, which is mirroring or following the realized volatility as well, right? So when the market is quiet, both the realized volatility is low because the market is quiet, but the implied moves are also low as the market gets quieter. So in simple words, implied volatility is the market's expectation of future moves of the underlying. So if I say that the Nifty has an implied volatility of 18 or 19 today, it's implying that the market's realized volatility over the next, till expiry will be around that number. But does it always stay around that number? We don't know. The market makes a guess or has an estimate of that, but this expectation is not always realized, right? And this difference between what is implied and what is realized is what we call the volatility premium. So implied volatility usually overstates the realized volatility. Okay. So, in other words, there's a beautiful example of given in an amazing book that you guys should read by Sheldon Nathanberg. He talks about, if you're expecting, if traveling is important for you, on your day job, and you're expecting it to rain today, then most likely you're going to carry your umbrella with you. If you have to walk to maybe the station to catch a train, or walk to catch a bus or whatever, right? Or if you're walking to work, you're most likely going to take your umbrella with you. Whether it's going to rain or not, you don't know, but you are going to have almost always, if you want to protect yourself, you don't like getting wet, getting into your office, you're going to be prepared, right? You're going to be more than prepared. You're going to expect the worst to happen. And that is one of the reasons that implied volatility, which is the market's expectation, overstates the realized volatility. So market expectation of an underlying move are always higher than what the actual move happens. People are either greedy, they expect the market's going up, they expect it to go up more, much faster, or they are very fearful. The market is falling, they are fearful, they expect the market to fall much more than what it actually does. So let's look at what this implied and realized volatility on the same chart, right? So this is the last 4 years. On the chart on the right is the last 4 years of the implied volatility and the realized volatility put together. The white line is the implied volatility. The orange line is the realized volatility. In this chart, it's called HV, which is also another word for realized volatility. It's called historical volatility. So historical volatility is the last 20 days, how the market has moved. So what you'll see is that there are enough number of times, especially in the Nifty index, long periods of time, almost if you look at 2019, for example, all the way from January, all the way till July, implied volatility overstates what the market was actually doing. What was happening? Market moved a lot towards the end of 2018, if you remember. And then there was a sell-off, right? 11,500 down to almost 10% sell-off. And the market expected that this move will keep happening. But what happens? The market goes sideways. And the implied volatility stays up there, realized volatility is falling. So implied overstates the realized volatility. A lot of times it will be almost the same. But then you'll have times where this will not hold, implied greater than realized, and that's COVID, right? COVID just blew the whole thing out of the water. So you see that the realized volatility is shooting up, implied is chasing behind it, market is expecting large moves. Large moves are happening, and that's why realized volatility will stay above implied for a while. But as you came out of COVID, look what happens, right? July onwards, market is still expecting large moves, but those very large moves are not happening. The market moves are quietening down. You see, of course, the market rallied all the way from 9,000, 10,000 to like 15,000. But these moves are not very large moves on a day-to-day basis or a week-to-week basis. It is trending in one direction, but it's not showing a very large volatility. Or the implied, at least the implied is much larger than the realized volatility. Then you'll see markets also go into phases where the market is fairly priced. Implieds are almost equal to realized. And then it'll come back to more normal behavior where the implied is more than the realized. You'll see most of the time the implied, the white line is above the orange line. And let's zoom in a little bit to maybe a 1 year period and see what the last 1 year looks like. And you'll see that this is that period, right? July, it's almost tracking each other. And then after this, you have implied staying above realized. This is where a lot of people have made money selling options, because you're selling implied volatility and what you're getting in return is the realized volatility. So you capture this difference. In other words, volatility premium. Okay. So just again, another show of hands, is everybody on the same page with me? So because this is the basis of a lot of things that we'll talk about in moving forward. All right, perfect. I see one hand. I see two hands. I see several hands. Good, good, good. All right. Now I will come to talking about a couple of option Greeks. A lot of people don't like to hear the word Greeks, but believe me, it's a beautiful country. If you ever get to visit, you'll enjoy it over there. But coming to options trading, some things that are important to understand is how to price your risk in terms of Greeks. Okay. The first thing most of you who are trading options will know is what is delta. Okay. Delta is nothing but the change in the option price as the underlying is moving. So if the underlying moves by 50 points, how much does the option price change? Underlying moves by 1 point, how much does the option price change? That is delta, right? And then we know that the delta doesn't stay constant at a particular strike. As the price changes, the delta also changes. My God, so much confusion. But people who are breaking down these risks, they have come up with a way to estimate how much delta moves with the change in underlying. That is nothing but gamma. Change in delta with the underlying price. First order Greek, second order Greek. Okay. If you're familiar with partial derivatives, this will be grade school work for you. But if you're not familiar with partial derivatives, what option Greeks are, just remember delta is how much the option price changes with underlying price. First order. Second order is how much the delta changes with underlying price. Okay. So first order and second order. Same thing with implied volatility. We talked about implied volatility early on, how much the market is expecting the underlying to move, and then how that expectation changes. Okay. So I know this session is in the market time, and some of you might be following what's happening in the market. I have the Nifty chart on my other screen. I see there's a big breakout happening out there. So if you guys have any trades going on, feel free to place your trades and come back. But if you have automated trades going on, then you don't have to worry, right? Automation will take care of it. All right, back to Vega. So what is Vega? Vega is the change in option price with implied volatility. So what can move? Underlying can move, and the market's expectation of how much it will move further, that can also change. That is the change in implied volatility. So how much does the option price change with this change in expectation is what is Vega. Okay. And second order of that is how much does the Vega change? So Vega also changes with the underlying price. How much does the Vega change with the underlying price? And that is what is called Vana. Okay. So remember what Vana is. It is essentially the same as this gamma of delta, gamma delta relationship, same thing, Vana Vega relationship. This is important to understand because the kind of trades that the risk reversal setup is essentially a Vana trade. And I will show you, I will give you some references to go back and read if you're interested on why it is a Vana trade. Okay. Of course, if you are simply buying options on this long breakout of Nifty over 17,600, then you don't need any of these things. You're just trading price, and you're trading what? You're trading the delta. You're trading just a move in the option price with the underlying moving. Okay. But we spoke about volatility premium, and the next thing is what is the risk reversal premium. So first of all, let's understand what is risk reversal and where it comes from. Okay. So risk reversal. What I've done over here is on this chart, I've plotted the implied volatility versus the strike of the option at which it is calculated. Okay. This is as of yesterday's close. Yesterday Nifty closed at 17,468. And these are all the strikes. This is the implied volatility of those strikes. Now, can anyone on chat just put a message on what, if anything, peculiar you notice about this chart? Anything peculiar anybody notices about this chart of implied volatility versus strike? If you guys are still with me, somebody will see it. Anything peculiar you guys notice? Anybody with me? Santosh Pashi, you're not allowed to answer if you are still there. Okay, you don't know. But the first observation, perfect. Mohan is saying it's not linear. Perfect. What else do you notice about this chart? This is the key. Satish says inverse. Beautiful. What does it mean inverse? What it means is, as the strikes are increasing, implied volatility is falling. Implied volatility is falling, right? In other words, as your strikes are reducing, your implied volatility is going up. That means that options that are out of the money on the put side, I'm sure, I hope everybody is familiar with out of the money and in the money. On the put side, all the options that are out of the money, the implied volatility is increasing. For out of the money on the call side, anything that is above, all the calls that are above the current price are out of the money. All these options, the implied volatility is falling on this side. In other words, implied volatility is more expensive on the downside and cheaper on the upper side. Okay, this is called a skew in the implied volatility. Puts are more expensive than OTM calls. OTM puts are more expensive than OTM calls. Sorry, I was using the other screen, but this is the underlying price. Puts are more expensive than OTM calls. Okay, implied volatility is higher on the put side than the call side. Now, this is an observation that you make, that you must have seen in the market. How do you take advantage of this? By the risk reversal. What do? We sell these puts, we buy these calls. That's what the risk reversal trade is. You sell these puts, you buy these calls. Now, the question comes to how do you do it? What is the source of profits? All those things are details. But most important thing is that you are selling this skew in the implied volatility. You'll hear the word skew, a lot of people talk about. This is what the skew is. Difference between the implied volatility at a certain strike and some other strike. So if I take 17,750 and 17,650, my skew will be over here, it is 23, 750 is 17, skew is 6 points. Okay, so difference in implied volatility is the skew. The shape of the curve is looks like a skew. It's a skewed distribution over here. So you have a higher implied volatility, a lower implied volatility. So risk reversal trade, what is it? Again, sell puts, buy calls. But then a lot of you who are familiar with options and the delta of the option will say that what kind of trade? If I sell puts, I have positive delta. If I buy calls, I have positive delta. So I'm basically a long delta trade in this. Yes, risk reversal is a long delta trade. It is a long trade on the underlying. But what we will talk about is how to hedge that trade and trade a hedged risk reversal and what results they have. Okay. But before I do that, let me just mention, you can, if you are interested, you can go and read on this. But the expected profit of a risk reversal trade, this is the P&L, the profit and loss of a hedged risk reversal trade is proportional or equal to the VANA multiplied by a beta factor and the variance of the underlying. So the important factor is this VANA. VANA is the direct proportionality to the profit in this particular trade. So that's just something to remember. If you want to read deeper, go read the papers that I've mentioned, Hull and Sinclair 2021, SEP 2010. Okay. And you'll get more details on how this is derived and what that means and so on. But important to remember, VANA is what plays a big role in the risk reversal trade. Now, what is the risk reversal trade? Okay, let's look at a structure of a risk reversal trade. So in this example, what I've done is I've set up a risk reversal where I have sold the April 16,500 puts, just let's say 1,000 quantity, and I've bought the 18,500 call 1,000 quantity. Okay, so 16,500 put sell, 18,500 put call buy. Okay, now what you'll see is that those who are familiar with option payoff, the chart over here is an option payoff diagram. It shows the profit on the y-axis and the underlying price on the x-axis. So if the underlying moves from, this was set up yesterday when the underlying was 468, right? 17,468. The underlying moves up by 500 points, then how much will be your profit and loss? That will show on this y-axis here. So if the underlying moves from 17,500 to 18,000, if it does it today, the red line is today, then your profit will be so much. If it falls by 500 points, your loss will be so much. Okay, this is a payoff diagram. It's called a payoff diagram. There are several ways into how to create these payoff diagrams. One of the guys who's made a tool which does this very well is Santosh Pasi. You can look up his option oracle. This setup is done on a software that we use. It's called Wall Hedge. You can look it up. But of course, one of the conference sponsors who has beautiful tools as well is Quants app. You can create these kind of payoffs in Quants app as well. So, excuse me. This is the risk reversal. You're selling put and buying calls. What is the result of this? If you notice, 16,500 put, when I sell, the delta of that put is 16. The delta of that call is 14. So when I sell this put, I'm adding 16 deltas to the book into the 1,000 quantity, or 0.16 deltas into 1,000 quantity. That's 160, and then that's long. And then when I buy those calls, 14 delta, that's 140 deltas additional. So my total long deltas in this trade is 140 plus 160. Right? That's 140 plus 160. That is 300 deltas long. So if I start today, 300 deltas will be long in my trade. So this is another way to go long the index, right? If you want to trade long index, you can buy call, sell put. You'll get a certain number of deltas long. This is equivalent to how many lots of futures? Can anybody tell me how many lots of futures would I have to buy to get this quantity of delta long? 6. There you go. Beautiful. Everyone is still awake. I'm so happy. 300 deltas long, okay, is 6 lots of long futures. So you can create this structure and just trade directional also with this. But what we'll talk about is the hedged risk reversal, because we want to trade the premium, the risk reversal premium. Okay. Risk reversal premium is a subset of the volatility premium. Why? Because you're selling puts, right? So you're short volatility, but you're also buying calls, but they are of a lower volatility than the puts I sold you. You remember the implied volatility curve that I showed you, right? So I want to get the volatility premium, but I don't want the delta risk. I only want this risk reversal premium part of it. So what do? Somebody said it correctly, right? I sell 6 lots of futures in that trade. So now what I have is, I have 1,000 quantity call long, 1,000 quantity put short, and against that I sell 6 lot of futures. Okay. This will give me a delta of 0 or neutral delta. Now, a lot of you folks trade straddles, strangles, right? And you do neutral, delta neutral trading. So you might have thought that, oh, delta neutral trading means what? Sell a strangle, equal distance from the current price. Market is at 17,600, sell 17,000, sell 18,200. That's delta neutral. Okay. Yes, it is delta neutral, but the risks are very different compared to this type of trade. in this type of trade is also delta neutral, but you have different types of risk and you're trying to access different part of the volatility premium. When you're selling a strangle and doing delta neutral, you are accessing a different part of the volatility premium. You're expecting the market to move less. You're not expecting it to go beyond 18,200 and 17,000. You're expecting it to stay in a range. And so you're expecting a different part of the premium. Here we are looking at a different part of the volatility premium, the risk reversal premium, where the implied volatility on the put side is higher, the call side is lower. So we're buying this and selling this, right? So this is the hedged risk reversal. Everyone with me so far? If you're not with me, then just message and I can go slower and go back and talk about some of the concepts. But how would you go about putting this kind of trade, right? So let's look at some trade mechanics. Now you can't just say that, okay, yesterday I sold this put, I bought this call and I sold so many futures and I'm done with the trade, right? You can't just do that, because what do you do after it? How do you keep yourself in this trade at the neutral delta? Gaurav Sood has asked me to repeat. Anything specific, Gaurav, you want me to go over and repeat? If you can just put that in the question, I'll be glad to take that. Or if you have a specific question that you can answer towards the end, I will do that as well. So let's look at trade mechanics. All right, just from the previous slide. Gaurav, please put a specific question. If you want me to just repeat the trade structure, I'm selling a put and I'm buying a call. I have 300 deltas long. So I have sold those many futures and I'm delta 0, right? Neutral delta. This is the payoff of that structure of all these three legs. You know, all of you who have tools available to generate payoffs can go ahead and do this yourself. This yellow and the pink line is at expiry. The red line is as of yesterday. The green line is as of today. Okay, if you had put the trade on yesterday, this is what your green line would look today would look like. And then as time goes by, the lines will be move towards the blue, and then the yellow one is very close to expiry of 28th. The pink one is on expiry. Okay. So this is your trade setup. Now, the trade mechanics, how would you go about trading this on a regular basis? Is what you would do is you will set the structure up. You'll find this a 15 delta put, a 15 delta call. You'll sell this put, buy this call, and then you'll neutralize the deltas with futures. So sell futures. Now, those of you who are familiar with how options and futures are interrelated to each other, there is this concept called put call parity, where the future is equal to the strike plus call minus put. So you can replicate what is a synthetic future by just buying a call at the same strike, selling the put at the same strike. You will be replicating a long future. So you can convert this 3-leg trade into a 4-leg trade, where you are, instead of selling the future, you are just selling the call and buying the put at the same strike. Without going into that complication, where you're doing a 4-leg trade, let's just take futures and go on. Some people like to trade synthetic futures because options are involved and not futures. Or futures have a little bit higher cost than trading options. But you can just, for the argument's sake and for the discussion, let's just keep this as futures. So delta is 0. Now, the way to trade this hedge reversal, and I'll talk about how the Sinclair paper talks about it, is that they bring, so as you see that the market moves around, the delta over here is 0. That means what? The market moves up and down, you not make much PNL. But as the market moves a large distance, the slope of this line will increase here and will reduce here. So when it increases here, the slope of this line is nothing but your delta in the option, right? So your delta is going to increase as the market goes up, and it is going, your delta is going to, and it's also going to increase when the market goes down, and delta is going to be positive. So your delta will stay positive. Now, the important thing is that this delta is going to move around when the market moves. So you bring the delta back to neutral. Either you do it end of day, or you do it when it moves out of a range, right? So now you have 0 delta. your put is 15 and your call is 15, and together they are 30, 300 deltas, and you're selling futures, you're 0 delta. So you can set a range that when it goes out by half a lot, I will bring it back to 0 by selling maybe a call at the money, or when it goes out by one lot, I will sell another future and bring it back to 0. So when it goes out by one lot, what I mean is when the delta becomes plus 50, you will sell one future. So now when the market is going up, you are selling a future, right? And when the market will come down, you can buy it back, right? And then your delta will go back to 0. So this is one of the ways in which you can do it. You can do it within a range, or you can do it in a fixed time interval intraday as well. So if the market is moving around a lot, like today, the market started somewhere around 14,668 was yesterday's close, and then there was a big first 1 minute candle, and then it started somewhere around 510 or so, and then right now we are trading somewhere close to 17,640. That's 140, 150 point move, right? And if you look at it from yesterday's close, it's almost a 200 point move now, 180 point move. That's a large move. So you can say that, okay, even if there's a large move intraday, I will adjust my delta and hedge it back intraday as well. So you can do any of these multiple ways. I'll talk about how Sinclair does it. I'll talk about how we've done our backtest and what results we got. Okay. But you can choose either of these methods that you want to test. You've learned probably during this conference and other things that where you shared, you've learned how to do backtesting. You've got codes for doing all of that. And so you can implement your delta neutral behavior in any way that you want. Now, before I go on to the Sinclair paper, I will just come back and remind you of the relationship between the expected profit or the risk reversal, and that depends on VANA. Okay, so let's just very briefly look at how VANA of an option behaves as the underlying is moving. Okay, this is what I don't expect you to completely understand this, but just have a look at it and keep this in mind. I've gone long the 18,500 call. It does at 15 delta. Okay. What you'll notice is that the VANA of that 15 delta call, 18,500 call, the VANA has a maximum. You'll see that it has a maximum. This is the underlying price. The underlying is moving up and down. This is the VANA. The y-axis is the VANA chart, the VANA of this option. So as the underlying is moving down, the VANA falls from here, goes to 0. As the underlying moves up, the VANA falls, goes to a negative value here. Okay, so as the underlying moves, so remember the option is bought 18,500 somewhere here, right? The underlying is at 17,500, VANA is so much. Underlying is at 16,500, VANA is so much. What do you notice? There's a maxima in the VANA. This maximum happens where the market is currently at in this 3,400 rupee range, 16,400 to 18,000 maybe, right? In this range. So in this range, when the market is in this range, the delta of that option is 15, between 15 and maybe 30, right? If the market moves up, the call is becoming closer to money, and so delta will increase. So let's say between 15 to 30 is where the maximum VANA that you get. And if you remember the equation, the profit and loss is proportional to the VANA of the option that you have. So this is the VANA of a long call. If you plot the VANA of the short put, it will at 16,500, it will be the same. It will have a 0 here, and then it will show a negative here. But the maxima will stay at the money over here. What does that mean? That for an option that is out of the money, 15 to 30 delta, current price of the market is where the VANA is maximum. Okay. So those of you who are used to thinking about gamma, you will have heard that gamma is maximum at the money. That means what? That options that are at the money have maximum gamma when the underlying is at the strike of the option. Whereas when it comes to VANA, the maximum VANA is when the strike of the option is close to between 15 to 30, 25, 30, 20, that in that range of delta. Okay, just remember that, and that's why we are choosing the OTM options. And you remember from the implied volatility chart as well, the implied volatility just increases monotonically and in a non-linear fashion, increases much more as you go OTM. Okay. All right. So let's come to the trade on SPY, which is the spiders, which is the S&P 500 ETF. So in the US markets, ETFs have super liquid options. Here we have index options. Wahan pe there are index options as well as SPY, which is an ETF, uska options which are super liquid. You can trade them within 1 cent bid ask. So on an ETF option, how will you set up the hedge risk reversal? You sell 15 delta puts, you buy 15 delta calls, and then you can sell short 30 shares of SPY. Okay, so in the US markets, you can sell short equity, ETFs or equity. The broker will lend you that, they will charge you certain margin for it, and then you can sell short those shares. So you can do it with futures. If you have a large position, you can do it with futures as well. Now, so this is your basic trade. The same thing we did over there. We had multiplied by 1,000, so we had 300 quantity over there. So this is exactly the same trade. So what they did was in this study, they said, okay, we will delta hedge the position daily, and every once a week we will bring the puts and the calls back to 15 delta. Okay, so as you know, if the market moves, so if I start at 17,500, 18,500, 16,500 is my range. If the market in 1 week moves to 18,500, now that 18,500 call is no longer 15 delta, it is at the money, it is 50 delta. Okay, so now I need to re-establish my position at 15 delta. Why? Because I want the VANA to be maximum in my trade. Okay, so I re-establish at 15 delta. And then what they do is they don't take it to the last day of expiry. They enter 25 days to expiry, and then 5 days to expiry, they roll over to the next month. Okay, so this is the trade mechanics that they performed in that study. What do they find? That the CAGR is 5.2%, volatility is 6.9, and 22% maxed out. Now, of course, people in India attending this conference maybe are used to making 5% a day, right? Or maybe 5% in a week. Some of us make 5% in a month, we'll be happy, more than happy. But the idea here is to understand that this returns, whatever you're generating, okay, one is without leverage. And secondly, you are generating returns that are not related to the market, okay? And in an environment, in a market where the risk-free return is almost close to 0%, right? The Fed's fund rate is very close to 0%. You put your funds in a money market fund, you get like 0.25% interest, right? So when you are in that kind of environment, you are generating a CAGR of 5.2%. I think they did this over the last maybe 13, 14 years, right? But this is what that does. There's another variation of this which they talk about, and that is not making too many adjustments. So one of the things that I'll just mention, it's a little detail to get into, is that when you do adjustments, every adjustment that you do below your entry price is going to be giving back PNL. Every adjustment you do above your entry price is going to get you PNL. So every time the market is below your entry price and you're doing an adjustment, where adjusting delta or you're making it 15 delta again, the call and put, you're going to be giving PNL back, right? So you want to do fewer adjustments as possible. And we talked about that concept of where you will not do an adjustment until the delta is out of a particular range. So they did the same thing. They said that the position delta is hedged only beyond a certain net delta range. Okay, and they said the net delta range is 20 to 40 of each of these puts. So it started 15, 15 and 15 gives you 30. 30 is the total net delta. And they will adjust only when that 30 delta becomes less than 20 or greater than 40, right? So if they do that, then they find a much larger CAGR. The CAGR almost doubles, 9.6%, with about the same volatility. Okay, and so this is something interesting. This is pretty decent CAGR, if you look at it compared to what given that this is a very low correlation to the actual SPY. So if you're buying SPY and you're doing this strategy as well on the side, this has a very low correlation to it. So this is a pretty interesting result that they have when you're doing the risk reversal with SPY in the US markets. So we took this. I'm going to just finish up in the last 5 minutes. We took this and we said, okay, let's just look at a very base case on Nifty options and see what that gives us. And the results are not very promising. So the first thing is what we did. We set up the same trade that we had here, right? 15 delta short put, 15 delta long call, and then utilize the future. The only thing that we're doing differently, just for ease of backtest. We've not done. This is a part of our development process. We have not gone too much deep into this yet. And we're probably going to be looking at a lot more variables in here. But what we've done is we've taken a neutralized delta and then adjusted delta back to neutral every day, okay, end of day. And not only adjusted the delta back, but we are also rebalancing the strikes at the 15 delta every day. Right. So that is a lot of adjustments. So basically end of day, we are closing the position and we are re-establishing with new 15 deltas and a new number of futures short. So when we do that, we practically have no CAGR. Over the last, this is done from 2014 all the way till February 2022. So the last 8 years, there's practically no CAGR. So what this is telling us is that when you do as once a day kind of adjustments of delta, the intraday volatility is so much, or the difference between the calls and puts is such that the risk reversal premium practically doesn't exist for Nifty. Okay, this is what the current data shows us. So we said, okay, let's look at. So if you remember, we said that the range of deltas where the Vana is maximum is 15 to 30. And so we looked at 30, and again, this is CAGR, annual CAGR, close to zero. It's slightly higher, but it's close to zero, practically zero, right? Now, the idea is that it's important to understand what parts of the market can give you certain types of arbitrage opportunities, right? And so this is something that you can keep in mind. It doesn't necessarily have to have this, but a particular trade setup, but you can keep it in mind and you can opportunistically take this trade. So, and one idea which I can leave with you for this is to look at how pronounced this Q is. Okay. If you go to Quants is a sponsor on today's conference, and they have these beautiful discounts for you to use. If you go to Quants app, you can plot this implied volatility skew. What you'll find is that a lot of these skews are flat. A lot of them are very highly pronounced. Okay, so you can look at the distribution of this skew over time. So on the right here, I've shown you that. I've plotted the distribution. How much does the skew vary? In this case, it is just normalized. So skew is IB put minus call, the put minus call, divided by the difference in the strikes. Okay, the call strike, put strike divided by price. So it's just normalized. This normalized number lies somewhere between 0.5 is the mean. So typically 0.5 skew slope is the mean, and then it varies a lot, right? So you can think of ideas where you can sell this skew when it's somewhere here for it to normalize back to the mean, and you can maybe buy the skew. Buy the skew means what? You're buying puts and selling calls. If this implied volatility chart here would be extremely flat, right? If this would be extremely flat, somewhere like this, then I could buy these puts and sell these calls. And essentially, I'll have protection for my overall portfolio for very cheap, right? So if the skew slope is somewhere here, you can buy these puts and sell calls, and for it to revert back to the mean. Okay, so yeah, that's my presentation. I hope I've left you with some thought for ideas on what are different ways to that options are professionally traded. Some concepts of how instead of just selling volatility premium, you can look at how the premium varies across strikes, how this implied volatility varies across strikes. And of course, this is purely just introductory material for you. If you found it interesting, go and read the Sinclair paper, go and read Nathanberg's book, go and read the book by Hull on options trading. And if you have, if you find it interesting and you want more information, you can always contact me. All of these slides have my contact information. That's our company email, info@QC Alpha. You can send a mail there. I will get it. That's our Twitter handle. That's my personal Twitter handle as well. And I will be glad to interact with you, if you have thoughts or ideas or questions on this. The skew slow. So the skew is just your IV minus IV of OTM put minus IV of the OTM call, right? This part I believe you understood. Moneyness difference is just a way of normalizing that number. Now, if you look at Nifty, this curve might look like this. If you look at Bank Nifty, you might have a curve that looks. Let me see if I can annotate. You might have a curve that maybe looks like this. Or if you look at maybe ITC, it might look like this. I don't know. You have to go and look it up. But the idea is that when you use moneyness, or even within Nifty at different times, this slope can be different, right? So moneyness is a way of normalizing this difference in numbers. The entire curve can shift down. The entire curve can be lower, right? And then the difference will be different. So moneyness is just a way of normalizing the actual slope that you have, that is difference divided by the strike difference. Okay, and the strike difference is just taken. The strike difference itself is taken as a fraction of what the price is, the current price is. So call strike minus put strike. So whichever IV put you took and whichever IV call you took, the call strike minus the put strike. That's, say you take 1,000 points. In our example, we took 18,500 minus 16,500. So that's 2,000 points divided by 17,468, right? That would give you the moneyness difference. And then your skew slope is the skew divided by the moneyness difference. Now this is a normalized variable. And then what you do is you plot the histogram. So in every day of the last 8 years, what is this skew slope? And that is the histogram of that. Okay, that's the histogram of all the skew slopes that we've seen in the past. Now, what it tells you is that on an average, this skew slope for, I believe this is for a 12% difference. That's around 2,000 points. On an average, the difference in skew is going to be 0.5, around 0.5, somewhere here. Okay. So now if you find that today the difference in skew slope is 0.9, somewhere here, you know that it's elevated skew. Or if you see that it is close to 0, that means it is depressed skew, and the chart looks like this. 0.9 skew would be something like this. Okay. I hope I answered your question, Sarvan. Thank you for it. Anand Shukla puts the question: ratio spreads can be used to trade the skew. Absolutely. So, Anand, yes, definitely ratio spreads can be used to trade the skew. Just for everybody else's benefit, ratio spread. So what we did is a 1:1 spread. It's called a risk reversal. When you sell more number of puts and lesser number of calls, it's a ratio. Instead of buying a call, you can sell a put or you can buy a put and sell more number of puts. It's a ratio spread. Again, out there you are buying the implied volatility that is at a strike where it is lower. You're buying implied volatility here and you're selling implied volatility here. Okay, so you can absolutely do ratio spreads. It's your choice or not whether you want to keep it delta neutral. If you need to keep it delta neutral, again, you'll have to sell some futures and keep it delta neutral. Mohan is asking, is it better to follow log normal distribution? What this is showing you is that the skew slopes, it follows a normal distribution. the price distribution will be normal. But when you are converting it and measuring a skew, this is showing close to a normal distribution. It's of course skewed towards tails over here, but it's a normal distribution. Mohan, you can do these kind of trades pretty much on any instrument as long as it's liquid, right? Most large cap Nifty, Bank Nifty, definitely liquid. You'll have to analyze and see USD INR how it is. We haven't done that yet. That's something that's in the to-do list. Maybe you can look at Reliance, ITC, Infi, TCS, some of these liquid stocks, how this behaves. So definitely something to look at. Definitely. Okay, I think that's the questions I have.